Here's something nobody at your dinner table is talking about. While a war is actively reshaping the global economy, while oil prices are destroying family budgets, while the news is full of explosions and political chaos, the stock market is going up, not crashing, not panicking. The S&P 500 has outperformed nearly every other market in the world in 2026, right in the middle of a war that is reshaping the global economy. And if that does not make you at least a little uncomfortable, you have not thought about it hard enough. But before you get angry, you need to understand why this is happening. Because the answer says something deeply revealing about how money actually works. And more importantly, about who is getting rich right now while everyone else pays higher gas prices. Because the last part of this video is going to make you question everything you thought you knew about investing. So let us start with the obvious question. How is it possible that markets go up during a war? Most people assume war equals chaos, so it equals bad for markets. And historically, the first reaction usually is bad. When the Iran conflict escalated at the start of 2026, markets dropped sharply in the first 48 hours. Investors panicked. Headlines screamed. Buck checked his portfolio and said something we cannot fully repeat on this channel. But then something strange happened. Markets recovered, and then kept climbing. This is not a 2026 phenomenon. It has happened almost every single time in modern history. World War II, the Gulf War, Iraq, Afghanistan. The pattern is almost always the same. Sharp drop, fast recovery, then growth. And the reason why is not complicated. It is just uncomfortable. War is expensive, and expensive means someone is getting paid. Let us talk about who exactly is cashing in, because this is where it gets interesting. When a government goes to war, it does not fight with feelings. It fights with equipment, missiles, aircraft, ships, ammunition, surveillance systems, fuel contracts. Every single one of those things is manufactured by a company with shareholders. A company whose stock price reflects how much business it is doing. Defense contractors had one of their best quarters in years in early 2026. Lockheed Martin, RTX, Northrop Grumman. These are not small operations. They are some of the most valuable companies on the planet, and they are embedded inside the major stock indices. So when defense spending surges, those companies surge. And when those companies surge, the index goes up. And when the index goes up, your retirement account goes up too, if you have one. You might be profiting from a war right now without even knowing it. If you own an index fund, there is a reasonable chance you own a piece of the companies building the weapons. That is not a conspiracy theory. That is just how index funds work. But wait, because the defense industry is only one part of the story, and the next part is bigger. Oil. Let us talk about oil. The Iran conflict sent oil prices up nearly 80% since the start of 2026. 80%. That is not a typo. If you are filling up your car, you felt that. If you bought groceries this month, you felt that. Energy costs ripple through the entire economy. Transportation, manufacturing, food production, heating. When oil goes up, almost everything gets more expensive. So oil companies are printing money right now. ExxonMobil, Chevron, Shell, record revenues, surging stock prices. And again, if you own a broad market index fund, you own a piece of that too. Here is the cruel irony that nobody mentions. The same war that is making your weekly grocery run $40 more expensive is also quietly padding the investment portfolios of anyone who owns energy stocks. The pain and the profit are coming from the exact same place. But here's what almost nobody is talking about, and it directly affects whether this lasts. The Federal Reserve is sitting on a very uncomfortable chair right now. Normally, when inflation rises, the Fed raises interest rates to cool things down. Higher rates slow borrowing, slow spending, slow the economy. It is painful, but it works. They did it in 2022. They did it in the 1980s under Volcker when rates went all the way to 20%. But in 2026, the Fed has a problem. Federal debt is now at roughly 100% of GDP, meaning the US government owes about as much as the entire economy produces in a year. At those debt levels, raising rates aggressively becomes extremely expensive because the government itself has to pay more interest on its own debt. The policy tools that worked in 1981 are significantly more dangerous to use in 2026, so the Fed is stuck. Raise rates too hard and you risk a debt crisis. Stay too easy and inflation keeps running. And meanwhile, oil prices are doing the Fed's job for it, but in the worst possible way, by raising costs without slowing the underlying economy. This is what analysts are calling a stagflation risk, slow growth plus high prices. The 1970s comparison is not perfect, but it is not crazy either. And here is why that matters for your money specifically. Stagflation is the one environment where the standard advice breaks down. Normally, when things get bad, you hold bonds. Bonds go up when stocks go down. That is the classic hedge. But in a stagflation environment, bonds get destroyed by inflation. At the same time, stocks struggle. Both sides of the traditional portfolio get hit simultaneously. In the 1970s, the assets that held up best were commodities, gold, oil, real estate, and inflation-protected securities. Not because they were exciting, because they held their real value when paper money was losing purchasing power. Now, to be clear, nobody is saying 2026 is definitely the 1970s. The US economy today is significantly less dependent on oil than it was 50 years ago. AI investment is driving productivity gains that did not exist then. Corporate earnings have been surprisingly strong. But the risk is real enough that serious investors are paying attention, and if you are not at least aware of it, you are flying blind. Buck, for his part, just moved his entire portfolio into gold bars and buried it in the backyard. We do not recommend this, but we understand the impulse, so let us come back to the original question. Why does the stock market go up during a war? Because war concentrates money. It flows from governments into defense contractors. It flows from consumers into energy companies. It flows from emerging markets into U.S. assets. Because in a world that feels unstable, American markets still look like the safest place to park capital. In 2026, U.S. equities have outperformed the rest of the world by nearly 10% since March. Not because America is doing great, but because everywhere else looks worse. The market is not a moral instrument. It does not go up because things are good. It goes up because money has to go somewhere. And in a crisis, it tends to go to whoever is selling what the crisis demands. That is the ugly truth. War creates demand. Demand creates profit. Profit pushes prices up. And somewhere in that chain, whether you like it or not, your money is probably involved. The question is not whether you are comfortable with that. The question is whether you understand it well enough to make smart decisions with your own portfolio, because understanding it is the only thing that actually helps you. If this changed how you see the market, subscribe to Buckonomics.